Yo, what's going on, everybody? It is Thursday, December 15th. And today was a really cool day, and it was, for me, very entertaining. And I'm not being facetious. It was very entertaining. You know, at one point, the Dow was down almost 1,000 points. And I just find it really cool and interesting and entertaining, I'll use that word again, to watch the monetarists, you know, just really get whipped around. And I think it's not only fun to watch, I think it's necessary. You know, it's kind of like every once in a while in nature, you have these massive forest fires, and that brings nutrients to the forest, and then eventually you have new growth. The problem here is that you're not going to have new growth. You're going to have a lot of people, you know, blown out by this and whipped around. But unfortunately, the mindset, the mythology about monetarism is not going to change. It's going to stay there. By the same token, however, it gives us an opportunity. Here's what's interesting about today. I mean, yesterday, after the meeting, there was a little bit of a dip, and then there was Powell's comments, and then we kind of bounced around. We went up for a while, and then we went down on Powell's comments. Okay? And, you know, we closed negative, but suddenly today, I guess there was a reassessment. And also what we had today, we had two other central banks. We had the ECB and we have the Bank of England. They both raised interest rates too. So, you know, monkey see, monkey do. And then we were down 1,000 points. And remember, I don't have to really repeat this to you, but everything that happens in the markets in the short term is driven by this monetarism psychosis, because that is the single variable that these people look at, and they look at it in a very one-sided fashion. So they really don't understand it. They have a total lack of understanding. They just consider a very minor aspect of monetarism, but broadly, they don't understand it. And let me just say, before I even get into any more explanation, that I told you this was going to happen weeks ago, not because of anything having to do with monetarism. I told you that we were going to have a quarterly corporate tax drain that hit today, okay? It's going to end up being something like $100 billion. I mean, these are totally predictable events, these fiscal flows, these quarterly tax drains, plus the big one on April 15th. And I told you this weeks ago. I said when we get to mid-December, I gave you exact dates. I said when we get to mid-December, there's going to be volatility, there's going to be a pullback because we're going to have the quarterly corporate tax drain. So it's like, if I'm the weatherman and I'm giving you the forecast, you know, I say to you, well, radar and satellite images and atmospheric conditions, we know that, you know, in a week's time or whatever, there's going to be a storm, but then the storm is going to pass and everything's going to get back to normal. So you prepare for that. Now, you can prepare for that however you want. Some people, you might be short-term traders. You want to go short into this. Some people like myself, we're more investors, and I look at this as an opportunity to buy, and that's exactly what it is, because we're going to get through this period. You know, these are something, I've explained this so many times, these tax drains, we're feeling them this year because in the last 2 years, the amount of fiscal stimulus was so large, okay, because of COVID, that it swamped the negative effect of these tax drains. But the tax drains are a fact of life. I mean, it's like they say, the only thing certain in life is death and taxes, right? So we know they're going to come. I also said that by next year, it may very well be that the fiscal boost that we're getting from interest rate transfers, interest income transfers, that could end up offsetting almost completely the tax drains. And I'm going to talk about that in a second. But let me just state again, in case you're joining me for the first time, today's sell-off, and actually the sell-off yesterday and the sell-off since we went crazy on the opening on Tuesday with the CPI print. Somebody leaked, obviously. But the sell-off has been the lead up and the consequence today of this tax drain. When you suck out $100 billion, there's no buying power, all right? Somebody asked me a question here, Mike, how can the money be spent back in? How can it be recycled back in if when taxes are taken out, when taxes are debited, the Fed also debits reserves in the system? So the question was, how can it be that they get recycled back in? Very simple, because the government net spends. It deficit spends. So by definition, it is always spending more than what it's draining away in taxes. It's just that at some points during the year, 4 or 5 times during the year, we get these tax drains. They're big tax hits that the quarterly, corporate, and then the big one on April 15th. But the very fact that the government net spends, in other words, the definition, deficit spending, it spends more than it takes away in taxes. All right, that's what our so-called debt is. It's not debt. It's the accumulation of dollars in the hands of the non-government worldwide. It's not debt. It's dollars we own, not that we owe. So that's how it gets replenished, because the government is net spending. So getting back again, let me just state that the decline today had nothing to do with monetary policy. Nothing. Zero, zilch, nada, niente, squat. Nothing. All right. Now, you're not going to hear that anywhere else but right here. I mean, everything you are going to hear and everything you are going to read, it's about, oh my God, the Fed's going to keep on raising rates. By the way, if you look at Fed fund futures today, they did not move. They did not move. We're still looking at a 25 basis point hike in February. We're looking at a 25 basis point hike in March. That's where it was. So, to justify or to rationalize that today's big 1,000-point drop, and I think we settled down like 700 something, was somehow because of a re-estimation of Fed policy and what they're going to be doing, didn't really show up in the actual markets, okay? And the Fed follows that. I mean, whatever the markets say, that's basically what the FOMC does. I mean, why do we even need an FOMC if all they do, that's the monopolist in rate setting, but they don't act like a monopolist. They act like, hey, what's the market say? Okay, I guess we all better do what the market. If you want to know what they're going to do, I mean, you don't have to listen to me. You go to that Fed Watch tool at the CME, and it shows you right there based on where Fed fund futures are trading, and it goes out for a year or more. And you could see exactly, what they're going to do, because they just follow that, which is insane and stupid anyway, because they're the monopolist, they're the price setter. I've used the analogy in the past. Suppose you had John D. Rockefeller at the height of his power dominating the oil industry, back at the turn of the 20th century. Would John D. Rockefeller go around and ask all his little competitors, gee, where do you think I should price my oil? No, he crushed them. He said, either you sell me your companies for my shares, you give me your operations for my shares, or I put you out of business, period. He basically did that to the railroads too. He said, either you give me these tremendous discounts on my oil transport, or I'm not going to use you and you're going to bankrupt. You're going to go bankrupt. That's what a monopolist, that's the power of a monopolist. But these nincompoops on the Fed, who are all like monetarist, dummies, they don't understand. So anyway, to repeat one last time, today's sell-off was entirely due to the tax drain. Now, the question arises, how long does this persist? Now, I sent out to my subscribers exactly a price level where I think the market could go, and also how long it could take. I mean, there is a pattern to this. I mean, you could look back at prior tax drains like the one in September, and you get a pretty good estimate on the degree of, negativity for the stock market, like how much it could sink down. And I did do that today. I looked at the September tax drain and what the effect was, but I think we're in a little bit of a better situation now. Not that this is a bad situation. I actually think it's a good situation. I mean, I saw somebody post up today, and there were lots of commentary. Oh boy, this is it. It's all over. Ba ba ba. We're not going to have any Santa Claus rally. Let me tell you something, folks. Santa Claus is coming. And as a matter of fact, he's handing out presents right now. And the presents he's handing out right now are lower stock prices. That's a gift to you. Now, you could take that however you want. You could say, oh my God, this is terrible. This is horrible. The price of stocks are down. I don't know. Maybe when you go shopping for your favorite items and you go into the store and they're on sale, you say, oh my God, I'm not going to buy anything. The price is too low. I got to wait for the store to, end the sale and jack the price up, and then I'm going to go buy. I mean, that's up to you. I can try all I want to change your mind and with logic and understanding, but if you like to buy high and sell low, that's up to you. I don't mind at all. I do not mind at all. I'm going to keep doing this. Now, if you're a trader, look, I spent many years, some people tell me, like not all of us, we're not like in the long game, we like to play. First of all, I might not be for you, but I doubt that, because I think basic conditions and the big picture, that's for everybody. And I've been through this conversation before where I've had discussions with analysts who call themselves bottom up, and they're like, well, we don't look at the macro. All we do is crunch numbers of companies. In other words, we look at their balance sheet, their cash flow, their debt, all that stuff. And I said, that's great. I wish I was really adept at that. I have a course actually called MMT Value Stock Selection, and I've boiled that down to very, very basic principles of how to value a stock, and that works fine for me. But I say to these people, like, you might be the greatest accountant or financial analyst, but if basic conditions are not good, if they're not conducive to growth, your stock's not going to do anything. And vice versa, if basic conditions are good and robust and strong, you can buy dog stocks and they're going to go up. Now, I don't recommend that. But I'm just saying, like, what position would you rather be in? Would you rather be in a position where we have terrible macroeconomic conditions, but you're working hard to try to find something to go up? Or we have great basic economic conditions, and you can basically throw darts at a dartboard and make money? I don't know. For me, the simpler the game is for me, the more I like it. Call me crazy, all right? Just call me crazy. I don't like to work hard. I like to work smart. Hang on. New York, baby. Oh, come on, man. So anyway, this will pass. We are now, let me just give you some perspective, because as I said at the intro here, like these monetarists, they're looking at a single variable, which is interest rates, which they don't really understand, or they see that in a very myopic, very tunnel vision way, that it's just like a negative because, it raises costs. They don't see that the other side of that, which is the transfer. The government is a payer of interest, and as the rates go up, that just funnels more and more money into the economy in the form of interest income. And it's very, very significant. It's getting very, very significant. Now, we're like, 2.5 months into the fiscal year. And interest flows are already at $130 billion. 2.5 months into the year. I'll tell you, to give you some perspective, that exceeds the amount the government has spent so far on Medicaid. Medicaid is right now at about $120 billion, for that first 2.5 months of the year. More than Medicaid. Payments to defense contractors was 86 billion. We're at 130 billion on interest transfers. That's almost up like 60% over what the government is paying to defense contractors. I mean, it's sick. It's crazy. And I mean sick in a good way that they're pumping in. So like, and as I've been saying, that's just going to go up and up and up, because even if the Fed doesn't raise interest rates anymore, which they are going to continue to raise interest rates, and I want to talk about that in a second, but even if they don't raise interest rates anymore, at the current level of rates, as these government securities, the longer dated government securities mature and new ones get issued with the higher coupon, those interest flows are just going to be increasing and increasing and increasing. And by the way, I didn't even mention in that 130 billion, that doesn't even include what the Fed is paying to the banks on interest on reserves. I mean, you're talking about this may end up putting the COVID stimulus to shame. So frankly, I love it. I absolutely love it. You know, that these monetarists are freaking out and they're getting their asses handed to them, because it's necessary, folks. This is like the forest fire that clears everything out. But like I said, it's not going to clear out their mythology and their psychosis. That's always going to be there. But, you know, we need to burn them. I mean, we need to burn them. So that's really important to understand. And next year, you know, as I said, this is all going to ramp up. But here's the funny thing. You know, the Fed is going to continue raising interest rates, and that's not going to bring inflation down. Now, we've been lucky over the past, you know, 5 or 6 months, because oil prices have come down, and that's largely been due to the fact that Biden has, you know, basically drained out the whole strategic petroleum reserve. But that can't go on forever. And as the economy reaccelerates in 2023, it's already, you know, growing faster. Remember, the first half of this year, the first 2 quarters, we had a negative growth. Then we had, what, like 3% or something like that in the third quarter, and now it's going to be close to 4% in the fourth quarter. And next year it's going to be higher as economic growth increases. And also, don't forget that, you know, China, they had all those COVID shutdowns and lockdowns. They're starting to, you know, maybe ease back on that policy a little bit. As growth increases, petroleum demand is going to increase. The sanctions on Russian oil are going to remain in place. Russia's going to sell less oil because they have the price cap. So that's going to mean more U.S. exports of oil. We're going to be sending our oil out to the rest of the world. So this reprieve that we got on inflation, which the Fed says, and Powell even says yesterday, it's not where we want it to be. Like, they're kind of scratching their heads like, look, we raised interest rates so much and so fast, and inflation is kind of stubbornly baked into the system. Yeah, because you're raising the interest rate. So it's just going to be like a spiral. Next year, you know, they're going to be sitting there like looking at this saying, what the hell is going on? Like, inflation's not coming down. No, because you're jacking up the general price level by raising interest rates. This is economics, not for dummies. You know that book series, like whatever, you know, something for dummies. This is economics by dummies. Economics by Dummies 101. So they're just going to be jacking up prices. It's going to be good for commodities. It's going to be good for gold. I would say it's going to be bearish for the dollar. And by the way, this dollar rally, I played this, and I just made a lot of money on this because, you know, the reserve drain, the tax drain, that's bullish for the dollar. But, you know, that'll fade away. The only thing I have to say about the dollar, which makes it a little bit tricky because, and I've been saying this, is that the U.S. now is becoming such a large net exporter of oil, that's going to underpin the dollar. So where the dollar should be falling eventually because of this fiscal expansion, it might not fall that much because of the oil situation. That's an important factor, very important factor. So I know exactly when, the bottom's going to be hit. We could time it. We could see the flows. We could see the flows. We saw it in September. I gave you the exact freaking time when the thing was going to turn back up. And I gave you the exact freaking time when it was going to go down. In August, I said, when we get to September, it's going to go down. And then, in October this year, I said, when we get to December, it's going to go down because of the tax trend. It's not, I don't have some crystal ball, folks. This is just, it's knowledge. So there you go. You got to take the, you got to take like the mystery out of it. You got to take the hocus pocus out of it. It's all driven by money. And that's not the money that people think, which the Fed do in monetary operations. That doesn't change anything. Those are just recompositions of the financial assets in the economy. It doesn't add or subtract. What I look at is the actual filling up the swimming pool or draining the swimming pool. I think I got to say this every single time. Because if you could reduce your perspective to simply understanding, are they filling up the pool or are they draining the pool? You'll beat everybody. You will beat everybody, hands down. And you can go out, you can spend 15 minutes a day, if that, and then you could go out and do your life and make more money than anybody. Than all these, geniuses on Wall Street analyzing their charts or hanging on every single word that the stupid Fed says. It's crazy, man. It's absolutely ridiculous. Anyway, that's it for today, folks. I had a great day. It was really, really entertaining. I loved it. I just absolutely loved it. Bye.